Lyn Alden exposed how the Fed and US banks will collapse. The biggest picture thing I focus on over the past few years is this concept of long-term debt cycle, and that was originally popularized by Ray Dalio. And one thing I did was I would see his charts since his explanations, and I said, okay, that actually answered some of my questions, but I want to go in and determine, is this accurate, and can I explore this some other angles, and how can I quantify this in other ways? And so I spent a lot of time going through very old data sets and reconstructing all sorts of historical, fiscal, and monetary, different ways of measuring debt and monetization and inflation and fiscal deficits, things like that, interest rates. And I built this big data set that I then used, which formed my macro thesis that has been extremely helpful over the past few years, which is basically extending and deepening that long-term debt cycle thesis. And the short version is that idea that we always think of these short-term business cycles, these 3 to 10 year credit expansion and contraction cycles. And I think the important insight there is that because policymakers can come in and respond to when there's a credit contraction, they can cut interest rates, they can do fiscal stimulus depending on if you're talking about physical or monetary authorities. The point is they purposely kind of short-circuit the leveraging process, and then they try to get that credit growing again, and generally what happens is when you string a bunch of those gather, instead of like a sine we would credit expansion, you end up with like an upward sloping sine wave. So you keep getting higher highs in terms of debt, GDP, and then you get lower and lower interest rates because now there's more debt in the economy and there's kind of that more downward pressure on rates. And so you keep kind of building up more and more debt. And so that's what you can call the long-term debt cycle, goes through multiple cycles over multiple decades. And the problem of course happens when you get so much debt in the system and then you run into the zero bound. Or in some countries even mildly negative interest rates, and then there's really no further to go to allow that engine to keep going up. And then you start to get in. This happened in 1929 into the 30s, and it happened again during the global financial crisis. If you look back in terms of financial metrics, those were very similar, like in terms of, for example, how much bank loans they were in the economy compared to the size of the monetary base, right? So you're multiple on different types of money. Compared to deeper into the stack and how much credit risk you're taking on when you have that type of levering, combined with of course speculation either on stock market or houses depending on the environment, and when that all unwinds, that's a private debt bubble that's popping. It's very disinflationary. Money is being destroyed because loans are being defaulted on, and you started to get kind of a fiscal response, right? So both in the 30s and in the 2000s you had these ongoing fiscal and monetary responses to try to deal with that. And my observation was, a decade later is when you run into the other side of that crisis, right? So that part of the crisis is the private debt bubble of the disinflationary deleveraging crisis. But when you put all that debt onto the sovereign balance sheet, when you monetize it, when you go through this process, that has a number of consequences, right? So one is like I said, you put it all on the sovereign level, but you also, in both the 30s and the 2000s, you had periods of rising populism, right? So there's more and more discontent. There's basically this kind of a widespread understanding that the economy is not functioning well, and when they run into the next crisis. In the 40s it was, a lot of that populism turned into war, obviously, and here we had a very kind of still levered environment, high populism, slowing economy, ran into COVID, and now we have war. Both of those environments you generally get very, very large physical responses, right? Because it goes up to that level, and that's where you get that more inflationary or static inflationary type of situation. And so I've been making a lot of parallels between the 2020s and the 1940s, and as well as the 2010s to the 1930s, and unfortunately that does continue to play out, and in some cases it has, even become more literal now that there's some degree of kinetic war happening. It's a different phenomenon because credit contraction on its own is more disinflationary. That's kind of what we've seen in Japan, for example. They've had money printing at like the sovereign level, but they've had significant deleveraging at the corporate level, both in terms of increasing their cash allocations and decreasing their debt. Also, a lot of it has gone towards net debt reduction, and that's been an environment of low money supply growth and generally stagnation. Same thing for like the the 2010s and in the 1930s you had a reduction in the amount of debt relative to GDP among the private sector, and so that's generally a more disinflationary environment because you have low demand for things. Really slow growing demand compared to the prior trend.